Hello everyone, how are you now? Great, thank you for joining us and welcome to the next month's update of the Global Macro Fund December update for the month of December, it's the month of December. There you go. Look, that's enough jokes for now. Getting straight into it. First off, answer to your question is that yes, that is my dog and she always joins me. She's a pretty savvy investor, as you could possibly imagine. And yes, in answer to the second question, I do only own white business shirts. So look, I like to keep it simple. Why keep things complicated? That's my way of doing things. And you'll see as we go through the next few minutes here, as I walk through what we've done, what we haven't done. That I like to really just keep it simple. Don't overcomplicate things. Where's the money going? What are people doing? Where's the obvious trade? Go to the obvious trade. Don't try and overcomplicate stuff. Right. So let's crack on. Let's crack into it. So. Disclaimer, first off, we've got to tee off with the disclaimer, obviously. This is all super general advice. There's not much more that I really need to say on that. Everyone knows how this works. Do not take any decisions out of this. It's not suitable for you. If you want suitable advice, come and talk to me because that's what we do, but it means that we'll have to actually get to know you and that becomes personal advice. So just cracking on with that. Now, I always put in a chart like this. I always want to have a bit of a look. So having a look at this chart is interesting because you can see November down the bottom. So this is a chart of the S&P 500 since 1964 to last year, showing the best performance over there in that third column versus the worst performance for each month and the average return between the whole two. Obviously, you get the best month, say November, up at 10. The worst month down below 11. So this is since 1964. The standard deviation of 4.3%, more or less. Don't worry about standard deviations. We'll get into that later. You can see November has on average been up 68% of the time in those years and is on average up 1.2%. That's amazing. So you can actually sort of just look at that. If you did nothing and you knew nothing and you just did that, you'd probably do okay if you just did that simple seasonal up and down month by month. That's how we're going to go. For December, it's up 1.3% on average and it's up on average 71%. So we continue to be bullish at a basic level. If this is the only thing that you listen to, we continue to see that there is a bull case in December for the end of the year. Don't be too silly, don't be too hasty. Now, I've said this before on TV a couple of times the last week, but keep in mind that at this time of year, there's two types of fund managers. There's fence swingers and book squarers. So the ones that are behind, they want to be fence swingers. They've got to try and catch up to an index that they've got. If they're below that benchmark and their clients have a look at it and just say, hang on a minute, if the market's gone up 12% and you're already up 6%, you're way behind, so you've got to do it. So they've got to try and lead this up. If someone's behind by a little bit, that's great. Right now, we're right. So we're thinking that it might be time to be a book squaring, which means just join the market, be the market. Don't try and do anything too funny. Don't try and do anything too fancy. The market comes off a bit, then come off with it, that's fine. The market goes up a bit, then great, you're a part of it. So that's sort of what we're potentially looking at. At a really base case level, that's it. Let's drill down into the rest of it and see what else we've got to have a look at. So I continue to say be bullish. What did the market do in November? Up about 11%. So we got ourselves a new sort of, I think I had it written down somewhere. It was it's the best since 1927 or something like that. I've also got a nice cup of tea here, so I'll just stop for I'm drinking green tea. It's actually really nice. So if you want to know which one it is, then let me know. But it's a really nice green tea. So the S&P was up about 11%, which is pretty fantastic. You can see there's a couple of little, if I'll just point to it up here, there's a couple of little volatility events that really made everyone cautious. So it wasn't just to buy the market and relax on the market, that was it. Notice at the start of November is pretty much where it all started. I mean, we all know what happened in the first week in November. The election came through. It wasn't the blue wave that we all thought it was going to be. Trump got, he got a few more votes than everyone thought that he was going to get. He didn't get swept away, but a lot of people thought that he was going to sweep it too. We had what I had been warning people about, which was what was called the red mirage, where for the day, as votes came in and they were being counted, and for the evening, it looked like Trump had won. But then the postal votes that got counted second, that's what we were keeping an eye on. The postal votes came through, and as they came through, it made it look like the election was being stolen away, which is exactly what Trump wanted to have happen, because he knew that he was facing a potential loss. Because of the postal votes, more people vote by mail that are Democrats, and he also told people, don't go and vote by postal because it's corrupt and it's criminal. Go out and risk your lives and risk your family's life and go and vote in person. we're in the middle of a pretty big storm right now, so I'm just going to keep an eye on this one. If everything gets knocked out, I've got to do this again. It should be a bit of fun. So Trump said, go vote in person, vote in person. That's what made it look like the states were going red, and then all of a sudden they switched around and they switched to blue. As those postal votes came in and they claimed fraud, What I was very, very cautious about in the first week of November was that if it was close enough to be really, really contested, and I mean really knife-edge close, that those postal votes just weren't going to be enough to be able to overthrow it and overflow it, then you would have a real situation on your hands where people would actually then take to the streets, and then you'd have public unrest, and then you'd have the potential for some serious civil unrest, and by that I mean Trump actually activates the Proud Boys, for example, and that could happen, don't forget, it could have happened. It was a very real possibility. So I was saying that in that sort of situation, you don't want to be anywhere close to the US equity market. You don't even want to be long US dollars. Long the rest of the world because it's a US specific event. But just let that happen. A mess, like potentially another civil war could have happened. It was a real serious possibility. The thing is that it just wasn't close enough. But have a look at some of these volatility events that are in here. I'll give you a closer look on this. So some of the vol events that we are referring to, and I'll just sort of highlight over here that event there, that candle, that was a real doozy. That was the market saying there is a huge rotation afoot and there is a switch from this growth areas to the value sector, and everything is over, and oh my goodness, it's all going to change and we all have to freak out and panic. I was very much okay, relax, take the opportunity to join the market, don't worry about it, it's all going to be okay. The rotation doesn't happen until the rotation happens. I'm going to stress this again. You need, if you play it backwards, all the things that you need for that actual rotation from growth into value need to actually happen first. So you can't get ahead of yourself. So if you play it backwards, you need interest. Okay, what you need is real rates, interest rates to go up, which then means that you have a revaluation of growth stocks. Because growth stocks are great. You can forward value growth stocks because the cost of money is effectively zero. You know what I mean? So if the cost of money is zero, then you can forward them because borrowing is nothing and everything is fine, and the valuation of those stocks can be amazing. That's great. But as soon as you tweak up interest rates, it starts to add to the costs for those growth stocks, which then means that you value them differently, and you have a look at them and you have a look at value stocks that potentially make more money as interest rates go up, banks, etc. And you think, okay, that could, maybe that's where I need to start switching. But then, okay, to get interest rates up, then you actually need inflation to pop up a bit. To get inflation to pop up a bit, you actually need the growth and the reopening and prices to actually keep on increasing. And you need spending to keep on going. To do that, you need the reopening. To do that, you need the vaccine, or for people just to stay inside for 3 weeks. How hard was it, America? But that's all those things that you actually need to have happen. And to have people stay inside for 3 weeks, you actually need someone in leadership area to actually ask them to do so and tell them to do so. People have to want to get it. All those things have to happen. So you can't jump ahead and just do a complete rotation into a completely different sector from growth, which has just been an astounding performer for so long. You can't just go and just do that now, predicting that potentially all those 5 or 6 things actually have to happen. Because even if inflation goes up, it doesn't mean that interest rates are going to go up. We've seen that happen before. We saw it happen before with Trump. He wouldn't let interest rates go up. It wasn't his decision, but he made it his decision. Don't start me. So that's sort of what we can see that it's spinning into. Now, I think that Biden will be probably a much friendlier president with regards to the independence of the central bank. So if inflation does pop up for any long and continued time, then theoretically the Fed would then let rates rise. However, the Fed has already made a statement saying that they're not going to raise rates if inflation does go above a certain number. So it's like they've already said that it's not going to happen. So you need to talk about real rates. Don't worry about that. That's a complete nightmare. However, so flicking it back on so you can have a peeky at this one. So yes, November was up 11%. Coming off a super low base as that sell-off at the end of October came through in the risk-off event, that people didn't want to be holding too much equity into a potentially contested election, which is smart enough. That's fair enough. It also meant that November got a really, really good start. So people are saying it's the best November of all time. Okay, let's just pump the brakes here because October was October was a really bad October. Octobers are usually bad, but it was a pretty bad October. Now I was up about 4%. I think the market was off about 2%. So that's about a 6% outperformance there. I'm pretty happy with that. With this one, I copped a bad underperformance on it too. I wasn't ready for that snap to be as quick as it was. And quite frankly, and I will stand by this, good tea. I will stand by this, that I think that the risk in those first few weeks of November was mispriced. That people were being too aggressively bullish on the market without knowing that there was a serious and a severe risk that Trump was going to do something drastic, and that there was a potential for a real sell-off in markets from a civil war event. I still say that it was a real possibility. So that's what we got. Now that little arrow that I made, that's that candle. Simple candles. Anyone who doesn't know candles is that it starts, if for a red candle, it starts at the top, finishes at the bottom, and the wick, which is this thing, is where it travels over that entire day. So this is a daily candle for the S&P 500. Starts there. Somehow it got up there, somehow it got down there. It may have done it both, may have done it up and down, right? That's what it was, but it closed down here. Now, Tracy Alloway from Bloomberg Business, she's fantastic. Hello Tracy, if you're listening, I'm a huge fan, you have no idea. But she tweeted something amazing, that the crash momentum stocks was 15 sigma event. Something should happen every one to the power of 48. It was an insane number of times. It's like something that should only happen once every 4,000 years or something nonsense, right? It was a huge sigma event. It just swung it around all over the place. So that was the momentum, the crash of the momentum stocks. Everyone was saying it was off. So that happened. It was a big event, and quite frankly, that was when a lot of people started to freak out. And it's better to be out of the market when that sort of thing happens. You don't want to be a part of it. Stand on the sidelines, let everyone tear themselves apart. Join it when you feel it's right. Now, obviously, we now feel it's right because there's more certainty in the markets. Biden is going okay. I'll get to the reasons later, but Biden's going okay. China is back. We're back. The world seems to be okay. We've got a vaccine coming out. I mean, we'll get to that in a sec. So, how do we do specifically? Now, I have, just double checking that I don't have any client names on it. Last month, I used a client account. I am using the same client account here. It ends 545 to demonstrate this, just so that I've got cumulative progressive returns. Last month, up 4%. This month, only up 2%. I'm kicking myself about it, but that's what you're going to do. This is a nice balanced account. Started a very nice, simple, balanced, self-managed super fund. Started on the left, finished on the right. Look at that, nice, simple, easy transition from there. Cumulative, so taking on the performance of the benchmark, it was beaten by the benchmarks, right? So the SPX is one of those lighter lines at the top. VT, it doesn't matter what those things are. There are other markets, it's MICI World, situations like that. I was outperformed by the market. Coming off a low base, I didn't join it quick enough. I'm kicking myself, but that's how it's going to go. If you get the 4% outperformance on the 2% underperformance, then what are you going to do? So, but it was safe, and I mean, hey, it felt safe, it felt good, and it felt positive, and we're ready to go into the end of the year. So I'm very happy with that. Now V3, which is our little quant that we run on the side, where we pick 5 of the best local stocks, 5 of the best stocks on the Nasdaq. We've taken a bit of a hit too. So as the market's rallying, we're learning a lot about this V3, this quant strategy. As the market, and I'll just pull up myself because I like to see myself talking, because that's just the sort of guy I am. As the market rallies and the market gets stronger, we see that we start to see a little bit of underperformance in it. So it's interesting because it's right now it's got a lot of tech stocks in it. It's got Afterpay, WTC, A2 Milk, Northern Star, Appen. Oh my goodness, look at that! And some of these stocks just got beat up a bit with the huge market rally that the Australian market has had. So very interesting, which is why you don't make this your only thing unless you want to take a really big risk. You don't make this your only thing. It's part of a portfolio, but it goes in there. Keep in mind, another big part of our portfolio is 10 to 15% holding in MVW, which is an equal weighted ASX 200 ETF. That means that basically if the market goes up, we'll still follow it up. That's okay. This is what you have for a little bit of outperformance, and it turns out potentially to hedge a bit of downside. So that's not too bad. Now, the NDQ is also in there as well, and we got a little bit outperformed by that too. We have one stock that just didn't do good. You're going to get that. That's why you have 5 and not 1. That's what diversity is all about. Diversification. So, shifting as we do. So yes, that was not too bad. That return. Now, I promise this is the last time I'm going to show this chart. Stick with the trade the plan the trade, plan the trade the plan. Whatever it is you want to do. Keep in mind this was still the plan, and it's coming to a place. So we now have a pretty close understanding of where we are in this scenario. Biden will be the president. Congratulations. So we're on the left column, the blue column. We've got probably a Democratic House and a Republican Senate. So we are in the top left box, which means, according to JP Morgan all those months ago when they put this out, and it's still pretty good, stronger risky markets in general and US leadership of other equity markets. Buy EM, Asian equities and currencies on less combative trade policy. Buy healthcare. Interesting, they say sell Brent crude versus WTI. Very interesting. I actually haven't checked to see if that's correct or not, but if that's worked or not. So those are the main plays. No, buy overweight emerging market Asian equities. That's one of their main plays, right? Stronger risky markets. It's great. Now, it is possible that, now I'm going to flick down to the next one, which is going to say that there's still 2 Senate seats in Georgia that need to be decided. And those 2 Senate seats will come up at the beginning of January. If they both go Democrat, then the Vice President, Kamala Harris, will get the deciding vote on Senate issues, which then means that depending that there aren't any people, you got those the blue dogs or whatever they call them that can shift and switch around, and there isn't anything. If everything just sort of stays the way that it should stay, it means that the Democrats have got control of the House and the Senate, and they've also got the presidency as well. Then you move into that bottom left box. Then it's on for young and old through the rest of it. Stimulus is then going to be up to the $2 trillion mark, as opposed to being down in the nonsense marks. It's bullish for gold, bullish for equities, bullish for the people. Buy everything. That's where it's going to be on. Everything except for the US dollar. So very happy with that. But keep in mind, that's the trade. If there's one tip I can take away from you, is that plan the trade the plan. Always go back to what the plan was. Moving on, stick with it. I can't make it any clearer than that. But say goodbye to that chart. It's the last time I'm going to put it on. If you don't know how to buy emerging markets by now, then you never will. So that's that. Like I said, December the 14th, the Electoral College will have its vote. And that's when that's when it's official, that they'll actually then start the real transition, because nothing actually happens until the Electoral College kicks in. The new US Congress will take office on the 3rd. The Georgia runoff is going to be on the 5th. That's going to be a lot of fun. So they just go through it again. It's the highest ranking candidates from the last one that they couldn't get a direct majority. That's it. What does it actually mean? So this is according to Deutsche Bank. What does it actually mean for them if the Democrats win two of those spots? It means that stimulus is just through the roof. It's going to go crazy. So their light blue line, which is on the right side chart, has, I'll break that down to you. It's adding 3 percentage points to the US GDP. That's what's going to happen through stimulus, through the fiscal stimulus, and just pumping into the US market, pumping into the US economy. You'll have no idea just how incredibly amazing it will be for markets and for the economy. However, it's going to accumulate this colossal debt that doesn't really matter because it's just printing more dollars. But effectively, it means that MMT is most certainly going to be maybe the next thing that comes in after that. The money printer is just on. Janet Yellen is in charge of Treasury, so she's from the Fed. She loved printing money. She's the one who started this entire thing. Now she's in charge of the Treasury. It's going to be amazing. Right, moving on. What else have we got here? Now, the main news is the obvious one. So let's have a little look-see. So the main news, the Rona vaccine. I don't know. I'm amazed at who put those photos together that just says coronavirus vaccine. It's amazing. That whoever does these photographs is incredible. But get yourself across what the different vaccines mean. You've got the Oxford one, you've got the Moderna one, you've got the Pfizer one, you've got the Gamaleya, the Sputnik one. Don't worry, there's also some Chinese ones that are apparently working out really well as well. Their effectiveness or efficacy that people want to talk about, the Oxford Uni AstraZeneca one in the 60 to 90, depending on which mistake you follow with. The Moderna one, 95. Pfizer BioNTech, which is a really fascinating one. That was the first one to come out there. Pfizer, I'll talk about that in a sec. That's 95. And Gamaleya is 92. No, the real interesting one that's here, I'll pull myself up because I like to see myself again. So, is my dog still in shot? Good, okay, she's doing a wonderful job. The storage. Note the Pfizer one needs to be kept at negative 70 degrees. And the Moderna one needs to be kept at negative 20 degrees. So it's really hard to do things like that. I think the Sputnik 5, let's just not talk about that for a second. Let's talk about the Oxford one. The reason why the Oxford Uni AstraZeneca one is so important, and so important to the emerging world and so important to the developing world, is because it's a regular fridge temperature that it needs to survive. That's really important. It means that you can actually transport it to the world. It means that it can go to the world, and you don't need to have dry ice for this Pfizer BioNTech one. at negative 70 degrees. Now that is also something that I want to talk about. So, okay, when there was a bit of hesitation with regards to whether that Oxford Uni AstraZeneca one could actually be brought out, okay, that's why, you know, they were saying that if there's any hesitation with the Oxford one or the AstraZeneca one, then it means that emerging markets maybe won't get a vaccine quick enough, which is a pretty bad situation for them to be in. It's cheap, it's easily refrigeratable, that's a new word, so it's good for the developing world. That's what you got to remember. So if that's bad, then it's bad for them. If it's good, it's great for them and everything goes. I'm sure that it's going to be fine. The thing that I do want to talk about is that Pfizer, let's just take it easy, because all of these things that we're reading here is drug companies' press releases. Let me know. I'll have a lot of confidence. Okay, I like taking risks, but I'm not reckless. I'll have a lot of confidence in the numbers that are here when I actually see peer-reviewed in medical journals and actually see the conversation about that, as opposed to we've had a couple of people, this is a success trial, this is the end of our phase 3 trials, and here are some numbers that we've got. It's a press release. Please do not forget that Pfizer is the world record holder for the largest marketing fraud in drug company history. Let's just remember that, okay? I'm not an anti-vaxxer. I'm a huge vaccine fan. Vaccinate my kids, vaccinate other people's kids if I had to. But let's just remember who these companies are. Okay, that's my job is to invest in these things. I'm not saying fear the vaccine. I'm saying let's just wait until this is going to be before everyone gets ahead of themselves from an investment case. Okay, Pfizer's Pfizer, but the BioNTech, run by two people, a couple, they're scientists. They met in university or doing their third PhD or whatever the hell they were doing. They met. One is in one side of science and one is in a very closely similar science. Together, they're like the perfect brains to go together to create exactly this vaccine. What it does, as opposed to it being a usual a dormant or a deactivated virus that most vaccines, so polio vaccine is a dormant, is a dead virus. It's not really. I'll get to that later. But a deactivated type of virus. That this one actually sort of it asks the genes to do certain things, and it's like it says, okay, we need you to now stop or fight this virus that's in there, as opposed to being different. It's an innovation. They've had this company that both of them worked in the lab on their wedding day. They are exactly in that direction. They don't drink, obviously, so they couldn't even crack any champagne. Became billionaires overnight with this announcement, with this team up with Pfizer. Amazing, good for them. They seem like good, smart people who deserve. I don't know. But we'll see how it goes. See how it goes. But I reiterate. Let's just see a bit more fact come through. Right. Oh, how bullish is it? It's the sleeves. The sleeves are rolled up. Jim Cramer's all over it. Okay, how bullish is it? Look at what Jim's got to say about this. The presidential election is a certainty. COVID-19 vaccines are there. The reopened economy is definitely on the horizon. An urban flight. Don't worry about that. The next search for the next Tesla. Everyone is on the prowl, looking for what the next amazing tech innovation is going to be. Get amongst it. I talked about robotics last week. It's fantastic. The Robinhood investors are now a huge proportion. So retail is now a huge proportion of the market, pushing everything up. What else have we got? The buyers are over at Excel. That's an obvious thing. Thanks, Jim, for another obvious statement there. There's a huge environmental movement, which is actually really bullish for markets because it means that there's that stocks that are in that direction are in that move, in that scene, are getting a huge boost, and also some stocks are actually changing their ways that aren't too environmental. They're changing their ways too, and it's for the better. So it's really good. It makes the market more investable. It also makes those companies more investable for all people. So it's really good, really handy. The end, potentially, of the US-China trade war. Take it easy, because I've got something to say about that. And the markets welcome a Biden transition. The adults are back in the room. I can't stress this enough. You know, less volatility, more sensible staff decisions, less sackings, less tweeting. It just makes more sense. It's just a market in which it is easy to invest. So yes, we are bullish, and that's why. Now, the fund manager survey came out a couple of weeks ago. It was the most bullish fund manager survey of 2020. Vaccine, election, macro, obviously all these bullish things. It showed a big drop in cash. Cash numbers have now gone from 4.9 to about 4.5%. 20-year high in GDP expectations. A big jump in equity, small cap, and EM exposure. So the first, hold please, hang on. Now hang on, I'm just going to have to pull this up from here because that's what I do. So let's see if we could pull up the old So this is the fund manager survey. Make sure I've got it here. I'll take my face off the page. This is the Bank of America Fund Manager Survey with their top takeaways. So, why muck around? I'll just show you exactly what the report is. I get all these amazing reports. They're all fantastic. So the bottom line, it's the most bullish. Yes. You know that. Cash, what did I say? Cash has gone 4.1 from 4.4. I was close. Sorry about that. It's getting very close to being a sell signal. So fund managers are ploughing more cash into the market. Favorite trades. Ask for their 3 favorite trades for the year ahead. Long emerging markets, long S&P 500, long oil. Right. That's easy. Just do that, right? Don't worry about anything else. More people think that we're early cycle than recession. That's another big one as well. That means that's crossed over. The last time it crossed over was here, right at the start of big rally. Global profits are going to increase. Look at all these. Everything is bullish now. It's almost too bullish. There's too many bullish occasions. This is interesting. Yield curve expectations at all-time highs. That's great. If the yield curve goes up, like I said, that's the rates going up. That means that you actually need to start shifting out of the growth stocks and start looking at those value stuff, and that's something to be aware of. Cash levels are way down. That's very bullish for markets. Biggest tail risk there. Vaccine will be announced. So the professionals think the vaccine will be announced. Interesting. So in August, they think February 21, a credible COVID vaccine will be announced. Now it came out just after that, so they're all wrong. So that's what they think. So for February 21 is the biggest number. They were all wrong about the exact number. They should have said November. November 20 was the exact number. It was almost exactly after that. So it's interesting. So they're not always right, and they're not. But it just shows you where the weight of money is actually flowing. Investor optimism, overweight small cap and emerging markets. I would just do that. If there was one thing, James, do 3 things. Long emerging markets, long small caps. So I've got a couple of ETFs that I got for you. So, moving back to my beautiful face while I do this. Hello, thanks for joining us. So that was the Fund Manager Survey. We're all really happy with that. Super bullish, it's great. Now, let's have a bit of a look at emerging markets. May we? We may. So, looking at emerging markets, I've got the Bank of America numbers, and I've also got the Deutsche Bank numbers as well. So these are the two surveys. We'll just bring it in here. So this is the Deutsche Bank one that's here. So let's see what's coming up. This is a bit of information. This is cracking information for you right here. Get a look at it. Their view of the world. Outlook has improved since September thanks to positive vaccine news. For the US, near-term downside risk from COVID, obviously. So many people dying per day. It's clogging up their health system. It's an absolute nightmare. But, things march on. Euro area. Vaccine optimism is fantastic. China, stay on the strengthening trajectory. I'll talk about that in a sec. And emerging markets, Q3. So emerging markets in general, Q3 was better all round. Second wave is different. They say go long. So just specifically talking about emerging markets, because there's a lot of stuff in here that they've got. Specifically talking about emerging markets, and I'm just going to pull it up because I had it here a second ago. That's Euro, that's Germany, China. Now, China's real GDP growth forecasts, incredible, to 2.2% for 2020. It's already probably through that, but 9.5% for 2021. The GDP between now and then will grow by 9.5%. So that is phenomenal. That's the highest one that I've seen so far that's in there. Doesn't matter about, all this stuff is in there about why. Great, their GDP will grow by that. You can be confident that China will most probably hit something close to that, I believe. Now they've got their little numbers here, and they're waiting for the Southeast Asia to catch up on their outperformance. So this is Barclays. Which is the other research report, which I'm just bringing up here with the emerging markets. Where was it? China, upgraded forecast in China by that and that to 8.4% and 8.9%. respectively. So China and India will both grow significantly. 8.4% growth in China in GDP growth next year. Again, very bullish. Morgan Stanley, anyone out there who listens to the Morgan Stanley podcast, they're at 9% GDP growth for China. It's bullish. It's not too bullish. It's just perfectly bullish, just enough for me. It also means that what happens is going to drag up All of these other emerging markets with us, they all get the tailwind through Chinese growth. Also, China grows because they're more of a services economy, less of a manufacturing economy, but manufacturing has already been a big part of it. But as they're a more services economy, that's people that hustle, they manufacture, they make more money. And this is single operators, single dual operators, small things. They're not all big companies, so it's just guys that are actually out there hustling. They make more money in their pocket. Services then catch it. Tourism then catches it. Everything catches it. It just keeps on going. The vaccine means that they can actually then travel around and all around China. Now, China's a bit on the nose at the moment on the global stage, but it won't stop them from spending money where they need to spend money. They don't care. So get on board. Do not be against that flow of that, because it's going to be absolutely phenomenal when that kicks in. Let's go back to the presentation so you can see what you're talking about. So, emerging markets, small caps, oil, S&P 500. Don't overcomplicate it. Now, emerging markets, how do we get a hold of the emerging markets? Look at these options that we've got from the top four, in my view, the top four providers. Three of these track an index. So I mean, it just means that of the options that you've got, three of them are pretty much doing the same thing. You've got Vanguard, State Street, iShares, which is BlackRock, and BetaShares in the bottom left. So Alibaba, Tencent, Taiwan, Maitan. Alibaba, Tencent, Taiwan, Maitan. Alibaba, Tencent, Taiwan, Samsung, Maitan. And then the BetaShares one is different. It's the Asian Tech Tiger, so it's just specifically that. Everything's in a different order, but same-ish sort of stuff, just in a different order. But there's a few other ones that are in there in that top 10 as well. So I'll let you have a really good look at it there. So that it just does show that there's not a lot of choice for what you can have in the emerging market space. Buy that, fine, good, and then you're there. Buy the Asian one, fine, and then you're there. That's great. Now I've had another idea, which is a much better idea. In my view, it's not a much better idea. Still listed in Australia, which means that you can be in and out. It's a listed investment company run by an amazingly skilled group of people at VGI Partners. It's the VGI Partners Asian Investments. The stock code is VG8. And look at the holdings that you got here. You've got Nintendo, Olympus does medical devices now. It's the gastrointestinal endoscopes. Kikkoman, they do the soy sauce. Crown, okay, that gets back in action again. Crown comes back from this, and the stock price actually hasn't been beaten up that much last time I checked. So this is all going okay. Yakult, we all know what Yakult is. Richemont, which is luxury goods. So it's what does well in Asia. 45% of Richemont's sales are in the Asia Pacific region. Pernod Ricard, same sort of deal. People are going to drink wine. People are going to drink the spirits. Pernod Ricard's got an okay offering. Pernod Ricard does GH Mumm, one of my favourite champagnes that I have. Get a great deal on that. I love buying exchanges as well. More people get money in their pocket, more people trade. We've seen this happen time and time again. Hong Kong exchange, Japanese exchange, and then QP, they do those, the mayonnaise. They got the mayonnaise sauce. So this is just my way that I'm a little bit different in how I'm actually attacking the emerging markets problem that I've got. And I'm just going to pull up a little bit of VG8 for you here, and then we can have a just look at it, see exactly how it's all going there. So, that's a 1 month chart, which is great. So let's just pull it all back here and just see exactly what's going on. Yeah, so from where I bought it, it's actually doing quite well there, on its way through. I see no reason to be any way hesitant on that. So off it goes, and there we go. So look, that's the holdings of the VG8. I strongly suggest you have a bit of a look at it in there too. Now, the last tweet, coming to a close now before I talk about some ins and outs. This is what's going on. Last month I mentioned that there was the potential for a tech breakup and tech to cop more of a beating. It seems like the attention has been taken away from the tech space with regards to breaking it up, although there's still some murmurings. The best that we got this month was just these two idiots going out and having Senate hearings over their Zoom calls. That is a very funny tweet in my view, because Jack Dorsey, who runs Twitter, has just he looks like the guy that eventually the board taps him on the shoulder and says, "Mate, we think that you've spent too long at the fair." Mark Zuckerberg scares the hell out of me at the best of times anyway, but look, that's what you got. So he does look like a robot, and there's nothing that you can do to tell me otherwise, because I actually do think that he is a robot. As for Jack Dorsey, beware, beware, beware. If you ever see a CEO presenting at anything and they're wearing a black turtleneck, you might just want to have a look at the books, because they're probably doing a fraud. So, as we've seen time and time again, the only person who could wear a black turtleneck and get away with it was Steve Jobs. May he rest in peace. So yeah, beware anyone who's trying to emulate that genius. Last sip of tea. Right, now let's talk about what we're in, what we're out. So I'm going to go to my face now, so that way I don't show you any information. Hello again. Thanks for joining us. And I'm just going to pull up a few things here because I just took some notes on exactly what I was in and what I wasn't in and why I was in it. It's interesting. So let's have a little look here, see, and just get into it. Just hold on a sec. Okay, good. Yep, that's all there. So some of the some of the exits that we had. We exited PAVE, which was infrastructure ETF, and that went, that went well. After the election came through, and it wasn't the exact blue wave, we thought that maybe the infrastructure space had just enough in it that we were okay taking some good profits on that. It actually continued to go. What are you going to do? Now that's why I hold more infrastructure names. So I hold XLI, which is the industrials ETF, and we're up about, just looking at it now, I don't want to give too much away on that about exactly the specifics and the specifics of exactly what we've got. But XLI, we're up, so it's a good 18%. It's a really good handy 18% on that we've got. Really happy to have it. That's the industrial sector in the US, buying those big chunky industrial stocks. Not exactly the same as an infrastructure ETF, but still good and still sort of connected in that space. Keep in mind, I also own the 5G ETF too. So FIVG, that's also going up amazingly. That's almost gone up to new amazing highs, and I still think that it's good. Maybe up here, difficult to sort of buy that one up here. While I'm doing that, what I'm going to do, hold on a sec. I'm going to pull that up there. Okay, I'll put that here, and as I click it, then you'll see. Brilliant. Okay, good. So yeah, 5G. That's the 5G chart. That's just gone beautifully well. It just keeps on going. I'm really happy with that. That's the 5G technology. So that's there's a lot of infrastructure that's in that too. Food, still loving food. Absolutely adore it. Look at my buy price down there at 5. It's currently at 603. Some big American names that are in that ETF as well. Really happy with that. There's nothing that I could not tell you that would change my view that food is going to be so amazing. Now, some stuff that I added to, really small stuff here. IJR, locally listed, small cap ETF, just came back. I probably just bought a little bit too high, a little bit too late. This was an exact example of where I hesitated in the beginning of November, didn't buy those small caps because I was waiting, and then did, and I think I've just sort of snapped back a bit. I'm not afraid to show you my buy entries on this one. There's no BS that's on this, right? That's a small cap. Next one was the US Consumer Services ETF. Now this one's got, I actually wrote it down, so this is IYC, so run by iShares, listed in the States, so annoyingly, that's taking the US currency on that. So this is the Consumer Services, Amazon, HD, Comcast, Disney, Walmart, McDonald's, Netflix and Starbucks, amazing. Then you've also got the next one, IYK. So that's going quite well. I'm happy to hold that for a bit, see how we go. IYK has gone better. That's consumer goods. So that's got Procter & Gamble, Tesla for some reason, Coke, Pepsi, that's good. So that's people with money in their pocket ready to buy. Have a look at what's going on around the world. People have got, the global consumer has got 7.5 to 10% cash saved up in their pockets of GDP. So 7.5 to 10% of the global GDP is held in cash savings by retail people. That's a big number. When things reopen again, as they do, the spend and the boom is going to be something that we probably haven't seen since after World War II. It will create a whole new generation, and it will just be something that we talk about for the rest of our lives. This boom, this reopening, 2021, unless there's some other bizarre event that sort of kicks into it, 2021 will just be phenomenal. So be aware of that, be aware of that. Like I said, we added more to MVW. I've got that in here as well. That's great. Now, the two things also going to add to what I was talking about with GDP. Chinese PMI numbers came out yesterday, absolutely blew the market away, right out of the water. That adds more fuel to the fire that I've got of the GDP, of Chinese growth really kicking off. Australian GDP came out today, through the roof again. Our recession is over. We're good. The corner is turned. It's on for young and old. Be a part of it or don't. Tell the story later on when you're going. We also added, not for everyone, but for some people, THCX, to cannabis ETF. Now, we probably just jumped it a little bit too high on a really volatile day, acting a bit silly, but it's come good now. You can see, and this was only a couple of weeks ago. So cannabis, with a very friendly presidential situation that you can see that I mean, it's a pretty easy thing to think about. That cannabis stocks that are in there will probably do okay with a friendlier administration that's towards it, and there's nothing really much more to say. XLI also, as I said, is in there. Just keeps on going. Looks like I might have just run out of gas there. I might be tempted to sell that. It's good profit to lock in, and maybe just do something that's a bit more market general. Like I said, just join the market, be like water. Now, I sold ResMed because I thought that it had run its course. That with the vaccine coming out, it was going to be less useful. I did sell it around up there at that 29, almost bang on 29 mark, and it's come off since then. So I'm okay with that. ResMed annoyingly is a company that I want to hold for the rest of my life, but you can't win them all. That's just how it goes. So moving that out of the way. All right, now we're done for time. Thank you very much. VFS Group, personal advice tailored to you. Investing in every corner of the world. Strong trading and portfolio management system. We run a managed discretionary account structure. It's not mandatory. It's if it's required for you and if it's necessary for you and if you're okay with it. We run NDAs. And we do quite well. As you can see, the performance wasn't out of the box. Didn't blow it away this month, but did quite well before that. So it's really just stuff that's good for you. And I do believe, I continue to emphasise that what VFS Group does is true wealth management. Anyone who tells you they're a wealth manager, just get in there and do the homework and see what it is. This is true wealth management. It's actually personal. It's actually for you. It's actually diverse. It's actually in lots of corners of the market. We're not the stock pickers. We're actually running some real strategies here. So any other questions that you've got, please let me know. Otherwise, thank you so much for joining me. It's been a great afternoon. I look forward to hearing all of your questions and talking to you soon. Goodbye from my dog and goodbye from me.